Hello, this is Sally's Book Club. We bring you the best global books every day. Hello, everyone. I'm Sally. In the previous two episodes, I introduced two investment philosophy books: George Soros' The Alchemy of Finance and Professor Malkiel's A Random Walk Down Wall Street. The Alchemy of Finance is pretty dense and not the easiest read, mostly presenting Soros' personal investment philosophies rather than practical advice for ordinary investors. In A Random Walk Down Wall Street, Professor Malkiel strongly criticizes technical analysis, partially questions fundamental analysis, and offers his own investment advice. His recommendation is to avoid picking individual stocks and instead hold shares in passively managed funds, long-term, to achieve market average returns. While sensible, this advice might feel a bit dull for most restless individual investors. Both books are undoubtedly important works in investment history, but their content isn't very practical guidance for retail investors like most of us. So, are there any investment books actually useful for retail investors? The answer is yes. 1. Up on Wall Street by Peter Lynch, the legendary Wall Street fund manager. The title might make you think it's some cheap self-help book at first glance. Someone boasting about their successful investment strategies. Sounds like some stock market scammer trying to make quick bucks, right? But in reality, Peter Lynch is to investing what Michael Jordan is to basketball or Michael Jackson to pop music. He elevated fund management to unprecedented heights. He transformed stock picking into an art form. Yes, you heard that right. Stock selection as art. Let me repeat that. Stock picking as art. His expertise lies in selecting individual stocks, exactly what most stock market investors care about most. In 1969, Peter Lynch joined Fidelity Investments and managed the Magellan Fund from 1977 to 1990. During these 13 years, he grew the fund's assets from $20 million to $14 billion with an astonishing 29% annual compound return rate. Anyone with stock market experience knows how insane this return rate truly is. The average annual compound return in stocks is around 13%, making his performance more than double the market average. Under his leadership, the Magellan Fund, unsurprisingly, became one of the world's most successful funds. Peter Lynch retired at his peak in 1990 and later distilled his wisdom into multiple books. One Up on Wall Street was his first and most acclaimed work. It sold millions of copies worldwide over decades since publication. Why such massive popularity? Besides the author's proven success, the book's practical content made it stand out. Instead of complex theories, Lynch systematically explains stock strategies accessible to average folks. Peter Lynch firmly believed this. Right. Anyone can spot potential tenbaggers, stocks with 10x growth potential. If I don't share practical advice soon, listeners might get impatient. Let's dive into Lynch's key insights from this book. The book opens with a bold claim: while institutions may outperform individuals on average, individuals actually have advantages in finding potential big winners. You might ask, can a retail investor really beat well-sourced institutions? It sounds unbelievable. But Lynch argues exactly that. He outlines two key arguments in the book to support this claim. First argument: institutional investors suffer from time lag in decision making. Quality stocks usually have obvious merits. If you present great stocks directly to institutional investors, they'd likely buy them.
The real question is why they often don't. Is it oversight or ignorance?
The reality is institutional weckbooms are rigid, rarely exploring unconventional opportunities. Institutional investors constantly monitor peers, research reports, and portfolio allocations. When others praise certain stocks, they just follow suit. Like teachers in a classroom, once one praises a student, others join in without spotting dark horses. Never assume professionals don't herd, they follow trends more intensely than retail investors. Second reason, strict investment constraints bind institutions. Corporate environments naturally impose rules. Investment firms are no exception. Restrictions dictate how much to buy, severely limiting creative strategies. Take Mutai stock. Many institutions hold it. Would managers blame you for buying more? Probably not. Following the crowd avoids personal risk, safety in numbers. This relates to herd behavior in behavioral finance. Professionals avoid risks to protect their jobs. Why take chances on unconventional picks when corporate guidelines provide safe options? That's just how organizations work, inherently conservative. As an individual investor, buying overlooked potential stocks is your advantage. At worst, you explain to your spouse, but institutional investors need layers of approvals just to buy unconventional stocks. Thus, institutional operators often adopt passive, just doing my job attitudes. But how did Peter Lynch succeed as a professional institutional investor himself?
Doesn't this contradict his own arguments?
Not at all. Lynch consistently applied retail investor logic throughout his career. Let's briefly examine Lynch's pre-fund manager background. Growing up in a family of 7 siblings, Lynch came from modest means with little investment knowledge.
His father, a senior auditor, passed away when Lynch was 10.
By 11, Lynch started working as golf caddy, not just for income, but priceless networking.
While advising clients on golf swings, he gained investment insights in return.
This unique education shaped his investment philosophy, not institutional, but billionaire-style thinking.
His first stock purchase during college quintupled, funded by caddying earnings.
He self-funded graduate school through trading, launching his legendary career. So what was Lynch's secret for picking multi-bagger stocks? Let's uncover his stock selection strategies. First iron rule of investing. Never invest in what you don't understand. As Lynch puts it, find investment opportunities in your daily life. Ordinary folks might not understand financial reports, but can observe what products sell well. Hot-selling products generate cash flow, which drives stock prices up. Take 2 legendary Chinese stocks, Yunnan Baiyao and Menglong.
Yunnan Baiyao stock soared after launching successful products like medicated toothpaste and sprays. Ever thought about buying stocks of companies whose products you use daily?
Menglong needs no introduction. Their hemorrhoid ointment speaks for itself. Though embarrassing to discuss publicly, increasing sedentary lifestyles make this stock worth considering.
These are exactly the multi-baggers Lynch recommends.
Lynch advises against investing in companies you don't thoroughly understand. If you can't grasp their business model or products, better steer clear. Even Warren Buffett avoids internet stocks, not because they're bad, but because he doesn't understand them.
Observe what beverages, snacks, or medicines perform well in your life. That's your investment research lab.
Second crucial point, analyze how hot products affect overall corporate profits. Lynch warns, don't blindly buy stock just because a product sells well. Companies often have diverse product lines. Pampers, diapers sell well, but Procter & Gamble has many other products. This reality leads us to Lynch's third crucial advice. What's the third recommendation? Lynch believes small-cap stocks often outperform large corporations, a view shared by experienced investors. Like small boats turning faster, small companies adapt quicker. A successful product can dramatically boost small companies' profits, unlike giants constrained by scale. When Jobs returned to Apple, the company had shrunk from tech giant to underdog.
Products like iPod and iPhone triggered explosive growth precisely because Apple was then relatively small.
Contrast this with P&G or Coca-Cola. Even blockbuster products barely move their massive valuations. For explosive returns, small caps generally beat blue chips. Important reminder, small companies carry higher risks too. Lynch offers more practical stock-picking principles worth sharing, but never follow blindly. First golden rule, target companies with boring or ridiculous names.
Remember the movie 3 Idiots? Initial overlooked due to its silly title before becoming a classic through word of mouth.
Similarly, flashy-named companies often get overvalued, while gems with bad names get overlooked until their true worth emerges.
Companies with terrible names but great operations can experience explosive growth when finally recognized.
Second rule, invest in companies with boring businesses like waste management, bottle cap manufacturing, or zipper production. Boring doesn't mean unprofitable. It often means flying under institutional investors' radar.
These hidden gems can deliver multi-bagger returns if bought low before market recognition.
Contrast this with overtyped concept stocks already trading at premium valuations. Third principle, target companies in socially avoided industries like funeral services or waste recycling. Public aversion creates industry barriers that protect profit margins. People may dislike the business, but capital always chases profits. Fourth opportunity, spin-off companies from parent corporations. Spin-offs often get unfairly dismissed despite their growth potential. The key isn't whether the spin-off is good now, but whether it can improve with independent management. Parent company backing reduces downside risk while allowing operational flexibility. Fifth strategy, focus on stocks ignored by institutions and analysts. Heavily tracked stocks resemble crowded battlefields, little profit left for retail investors. Entering such crowded markets is like pushing a cart into battlefield. Dangerous and unwise. Smart retail investors should target neglected sectors, positioning early before institutional attention arrives. Sixth tactic. Consider rumor-plagued stocks, those constantly accused of illegal activities without concrete evidence. Most market rumors never get confirmed. True corporate scandals usually erupt suddenly without prior leaks. Persistent, unverified rumors often create buying opportunities through artificial undervaluation. Seventh strategy. Invest in industries perceived as stagnant or dying. Take watches, seemed obsolete after Staff Keats, but reinvented as luxury items with huge margins. When China restricted luxury spending, Baiju producers like Mutai adapted through volume expansion. Never underestimate companies' ability to reinvent themselves in tough industries. Eighth principle, seek companies with hidden valuable assets.
Like a paper mill owning forest land containing undiscovered rare earth deposits. Now, here's the kicker. Who would expect a paper mill to own rare earth minerals?
If the paper company later develops these minerals, it creates bonus revenue beyond core operations. Such scenarios actually happen, hence scrutinize balance sheets for hidden treasures. Owning such stocks means indirect ownership of undervalued assets. Ninth rule. Focus on products with recurring demand. Lynch suggests asking, is their product popular? Will customers repurchase? Avoid toy companies like Toys R Us. Even hit products get bought once. Toothpaste, medicine, FMCG products enjoy repeat purchases, better investment targets. 10th principle. Analyze industry competition dynamics. Take Leifert streaming's rise, foreseen through smartphone penetration and mobile data of OFT. Price wars drove smartphone costs down. Xiaomi's affordable models democratized access. Telecom carriers' data rollover policies and bandwidth upgrades effectively reduced costs. In conclusion, investors should consider cross-industry competitive dynamics. Focusing solely on single market patterns makes you miss interconnected opportunities. 11th rule. Consider stocks that corporate insiders are buying. When employees collectively hold shares or executives increase stakes, it usually signals confidence in company prospects. They want the stock price to rise. United internal confidence often predicts future success. Such alignment bodes well for the company's future. 12th rule. Stock buybacks often indicate coming price increases, similar to insider buying. Buybacks reduce shares in circulation, creating supply-demand imbalance. Scarcer supply typically drives prices upward. Moreover, buybacks demonstrate management's confidence in fundamental strengths. These 12 rules essentially teach how to identify undervalued stocks, the classic buy low, sell high strategy. Finally, a practical method. Monitor P/E ratios of individual stocks and indices. P/E ratio equals market value divided by net profit. Lower P/E ratios suggest greater undervaluation for both stocks and indices, thus indicating higher potential future returns. For example, Hong Kong's Hang Seng Index fluctuated between 10-20 P/E over 40 years, dipping below 10.6 times and exceeding 29 times. The U.S. market historically ranges 10.22 P/E with 17 average over a century. China's A-share market shows wider P/E fluctuations since 1999, indicating higher volatility. But it's gradually aligning with mature international markets. Practical P/E strategy: heavy investment when indices like Hang Seng or U.S. markets dip below 10 P/E. When P/E ratios exceed 20, reduce positions for shares. Buy CSI 300 index heavily when below 11-12 PE. Sell when above 30 PE. Between these ranges, hold steadfastly. Resist short-term trading temptations. As the saying goes, holding stocks requires more discipline than staying widowed. Also screen for stocks with 5% plus dividend yields or sub-5 PE ratios. Maintain strict position control. No single stock should exceed 10% of your portfolio. Diversification remains the golden rule of risk management.
Hope you found this episode packed with practical insights.
Lynch's book remains popular precisely because his success-backed advice works in real markets. His logical explanations convince readers, justifying his Wall Street legend status.
Highly recommended reading for stock market beginners, an essential bedside guide. Thank you for listening. I'm Sally. Join us next time for more book insights.
That concludes our book breakdown. Find keynotes below the audio. See you tomorrow.